welcome to The Farm. On the show this week, why 6 months after India opened its doors, there are yet no takers for FDI in multi-brand retail. How SEC is enticing whistleblowers. And SEBI goes for the jugular in the Sahara case, asks for Subrata Roy's detention. It's been 6 months since the UPA government put its very existence on the line to throw open the doors to foreign direct investment in multi-brand retail. 6 months and no takers yet. Which is not to say that nobody is interested, but the investment, sourcing, state-by-state approval conditions that accompany a 51% investment have made life tough for retail businesses, foreign investors, and very busy for consultants and lawyers. Two of them join me today to talk about why there are no takers yet for FDI in multi-brand retail and the structural challenges facing such potential investments. Karan Singh of Trilegal and Paresh Parekh of EY, to both of you a warm welcome to the show. We start with the general question as yet. I've seen no proposals make it to the ministry in the last 6 months. Am I right or am I wrong? Are we still a long way off from an actual concrete proposal seeking permission to take benefit of this policy liberalization? Paresh.
I think there are no proposals yet. There are some discussions going on, but you just see the kind of conditions and again the interpretation issues on those conditions. Investment 100 million, whether it's bullet, whether it has to be over a period of time. 50% back-end investment. Surprisingly, it is 50% of FDI. So if somebody brings 1,000 million, is mandated to do 500 million. To add to the problem, some states are not on board. As you are aware, only 9 states and 1 union territory is on board. If you want to really go for such an application, you may have to create possibly 3 companies. Company 1, where you have the foreign direct investment in retail. Company 2, which is a company which will run stores in states which are not on board, or will run businesses which are not compliant with those conditions. And Company 3, where the foreign investor can take up to 100% and run cash and carry. To complicate this, you have a 25% restriction on the supply from cash and carry to these companies, assuming they are group companies. And hold on, they have not defined what is group company. Of course, informally we know that they are likely to go by the foreign trade policy of 26% rule or a 50% board. Imagine if you have to ask the supplier or let's say PNGs of the world to supply to 3 companies, 1 to cash and carry, 1 to Indian FDI retail company, 1 to Indian non-FDI retail company. It's a mess. There is replication of invoices, it's difficult to manage the economics, and to add to the problem, what if I have to invest part of the money to buy out as a secondary deal? Is it going to be counted for 100 million? No clarity yet. So I think there are a lot of issues around sourcing again, where I am, unlike single brand, where I can procure 30% from India. Here only 30% has to be procured, but from small industries, and they are industries where only 1 million plant and machinery investment is allowed. It's interesting to note that FM in the budget speech has mentioned that the benefits will be available for 3 more years, even if they pass the 1 million test.
So when you exceed your size limitations, you might still retain the qualification of small industry for 3 more years.
But it's not clear whether it will be extended to FDI or not.
So Karan, this sounds like paradise for lawyers and consultants, doesn't it? There are so many different structures that you have to work with to try and make this viable. Is that possible, or do you believe as of now it's a no-go?
Menaka, much to everyone's surprise, lawyers don't necessarily thrive on uncertainty. I think
I take it back.
If you don't have enough capital coming into the country, everyone suffers. And I think this whole policy was created for political expediency.
Right.
And I don't think enough seriousness or thought was given into creating this policy framework, and I think it needs a major overhaul. And I think we've alluded to the right sets of issues, and I think we're going to continue to see an environment where there are no applications coming in for FDI yet, until the government takes the issues that have come up more seriously. I think until the general elections, in any case, we don't expect to see any further clarification.
So you're saying all the way up to middle of next year,
that's right.
Most investors will hold back because they like to see the outcome of those elections before they decide to invest?
That's absolutely right. And I think one of the major factors for that is the opt-in ability for state governments to participate in this FDI framework. And I think the big risk that most foreign investors feel in that specific context is that if there is a change of political climate in a state, there is a serious risk of business interruption then.
But that could be an ongoing threat, right? Because that would continue or persist as and when we see different states go to elections.
That
So today a
could indeed
state
be
may have
one.
said yes to FDI. Tomorrow, if a new political dispensation says no to FDI, your compliance structure becomes non-compliant, right?
Indeed.
But that would be a country going back on its words, or a state government going back on its words. I doubt anybody will push it to that extent. Is that as extreme a threat?
I don't think there will be specific executive action to remove the restriction
Right.
or to opt out after you've opted in, but people could make life difficult
And impose
operators.
further restrictions on a state-by-state
or just
basis.
make it difficult on the ground,
Okay.
as has happened in the past with Indian retailers in
Okay.
states where they didn't want big retail to come in. We've seen that happening.
All right.
before.
But I'm sure that the two of you, between yourselves and your various teams and lawyers and consultants across the country, are trying to see if there are possible structures that could, and I won't use the word sidestep, but that could sort of walk through this minefield of complex regulation without going up in flames. So let me try and open with the example of, let's say, an existing foreign Indian joint venture in the cash and carry space. And if that Indian foreign joint venture now wants to extend that relationship into front-end retail, how would they do it? How would they do it while keeping all of these conditions in mind? Paresh.
So few options would be that if there is a retail partner involved already with the cash and carry player, a part of the FDI compliant business can be demerged, for example, into the cash and carry company itself. That could be one model.
Okay.
Alternatively, the part of the compliant business can be sold into the cash and carry company. Of course, valuation will have its own play, but there will be lot of on-ground issues like stamp duty on lease.
Okay.
Most of the players have 100 plus stores, and to get them transferred to the new company is really a difficult task. Similarly, there can be other structures where the retail company which is compliant can be pushed under the cash and carry company, so that the valuations of the cash and carry company is also captured, plus the retail company is also captured. So that could be model number 2. And to slightly do a variation, the FDI compliant retail company which is in states which are allowing FDI
Right.
can maybe franchise the brand and have a franchisee which is owned by the Indian company run the stores in the states which are not allowing FDI funded retail stores to open.
Okay.
So the issue which will arise in most of these structures is the restriction of 25% supply from cash and carry
to a group
company.
Okay.
And hence the cash and carry company on some supplies may have to earn commission instead of routing the sale through the cash and carry company. So the supplier supplies directly to the retailer, and for that there is a commission which is earned by the cash and carry company. But hold on, then there is a leakage, there is a service tax issue.
Right.
So you add up 12.36% on that commission charge to the whole
So
cost.
it's cost inefficient.
It's
in that
cost
sense.
inefficient.
Karan, would you say that instead of an existing structure having to migrate to something as complex as this, where you break up what you have and redesign the entire sort of blueprint, that it would be easier for absolutely new ventures to go into business? So is it possible that the first approval that we may see, or the first application that we may see, is of a new foreign investor who is not currently invested in India, entering India through an existing Indian front-end retail chain?
In the long term, it isn't more viable. I think in the short term, there may be certain efficiencies to starting afresh, because you don't have to re-engineer entire existing structure.
Right.
So the corporate, regulatory, tax and other inefficiencies that are associated with unbundling something and then recreating it will not exist there. But in the very short term, once the business is live and operational, the same sets of issues will again come in. Unfortunately, the states that are bought in aren't in clusters in terms of those that have bought in
So
and those that
those
have opted out.
challenges, the state
Those
challenge stays the same, the 25%
The sourcing
challenge
challenge
stays
remains the same, the capitalization challenges remain the same, the e-commerce, inability to do e-commerce challenge remains the same. And remember, a lot of these international retailers eventually want to go the e-commerce way,
Right.
and that's a big issue for them.
Okay.
There's possibly one advantage which you can see for the new players.
Okay.
For the players which have already invested in cash and carry, there's a real question whether the investments which have already gone, whether they will be counted as satisfaction of the 100 million condition.
Let's assume they will not. Let's assume that was what you invested in cash and carry. If you want to, invest in multi-brand retail, it's a fresh 100 million.
In that case, still for a greenfield venture, there could be an advantage, because where you do a brownfield kind of a deal, it's still open whether the amount which you pay to the existing promoters for buying out the business, whether that will be counted as an FDI investment under the regime. So that is still an open question.
So it's interesting. You're saying if an FDI player comes into an existing Indian retail chain, and I'm guessing that's what you consider as
Right.
brownfield,
Yes.
how would you qualify? How would that $100 million condition be met?
Right, because to add to the problem, 50% of that FDI has to go into backend.
Right.
And if you're paying someone for purchase of shares, how do you calculate that? Will you count the earlier expenditure which has incurred
By
by
the
company,
Indian company.
which has already invested into backend as partial satisfaction of that condition? Still open to interpretation.
I don't think the government's created a structural framework that encourages or facilitates people taking the economics out of the retail venture because of all the difficulties associated with the guidelines. And so people are going to be
What do you
forced.
mean by taking the economics out of the retail?
Well, if you can't put your capital into the multi-brand retail venture because of all the restrictions that seemingly apply, it's going to facilitate or create an environment where the Indian partner is forced to stay in the front end and the foreign JV partner is forced to stay at the back end.
But what if both are new?
Imagine that the Indian partner, who is a new partner for the retail venture, does not have deep pockets, and FDI is needed even for setting up new stores. And in the business, lot of expenditure happens on opening up for new stores, for security deposits, for makeovers, and so on. Question is, how are you going to channelize part of the FDI, which is 50%, which is not meant for back end, but for front end? How do you channel that to the retail company? And that, then you have to come up with fancy structures. And one of the option could be, yes, some genuine franchisers do pay store opening fees each time the franchisee opens a store opening fees, but it will all depend on case to case.
Okay, so when you say fancy structures, I can see you have some fancy structures laid down in front of you. You want to take us through what some of the possibilities are?
If you look at this structure, very interesting, where the foreign company actually wants to acquire or capture the stake or consolidate the value of the retail business into the cash and carry company. So you actually hold the retail company below the cash and carry company, again, which is FDI compliant, and you have a Indian company running a separate, completely Indian retail company. You can build streams of payments by having the cash and carry supply to the Indian retail company, where the role of cash and carry
But
company
wouldn't the Indian company have to be invested in this retail company, because the foreign company can only invest up to 51%?
under this model, there is an advantage. The cash and carry company and the Indian retail company will not become a group company, because there is no 26%.
Who is the Indian investor in the front end retail here?
Yeah, so there either has to be a separate Indian company,
So now
which
you're
is
talking about two Indian investors.
yeah, which is either
Which
maybe
can
a,
be brother and sister, mother and father,
not necessarily
aunt and
brother and
uncle.
sister. It can be an independent
It
person.
seems viable to you, Karan?
Well, it seems viable. I think clearly the one issue is that if the intermediate company here, the cash and carry company, has to be Indian owned, which means the foreign company can only take a minority stake in that. Otherwise, it becomes a foreign company subject to the FDI guidelines. And then the whole ownership in the retail company with the attendant problems comes into play. So I think it's not entirely capturing what the foreign investor would want to do.
Fair enough.
Yeah,
Okay.
so in that case, you will have to go for possibly this model, where there is an Indian company where the foreign company is owning less than 50%, and the Indian company is owning more than 50%, and Indian company is controlling the board.
Okay, so then
In which case, it becomes Indian owned and
downstream
controlled
is all
company,
Indian owned, yeah.
and it can be an operating company, and then this company can do a downstream investment. Interestingly, if this model is followed, there is an interpretation that this is not FDI. The investment made by Indian company, which is owned and controlled by Indian,
Got it.
is not FDI, and if that interpretation is accepted, there is a huge benefit. None of the FDI conditions apply.
I understand that, but that means that you have to find a foreign investor who is willing and happy to settle for a less than 51% stake.
But
That's
anyway,
right.
today the regulations allow only up to 51%. So we are
But
talking about
51% still amounts to some
I agree.
degree of
I
control, right?
agree. Yeah,
so
I
less
agree.
than 51% or less than 50% will
Yeah.
not amount to control.
Yeah.
I mean,
It would
you
technically
see
have to
a
be
lot of
49.
these structures are reminiscent of what was happening in the telecom space.
I know, which
10
is
years
the
ago,
most
which is
worrisome thing,
we
right?
are
in all of
recreating the
this?
entire environment, or the government is facilitating the recreation of that environment.
Right.
And we all know what happens when you drive
So
people to adopt.
Eventually, in this structure, you'd have some sort of side agreement between these two guys, if we were to sort of hark back to the telecom structure, whereby he has only 49%, but he has a bunch of other rights that protect his
I
money.
think that's difficult now in this environment, because the government has repeatedly said that any arrangements that result in ceding control would be
But
considered
then
as
why
a
would he
majority
come in,
interest.
bring in 49%,
Well,
lend his brand and all of that,
And that's
only to
why-
be denied control and
And
denied
that's why it's going to
majority
be
economic
difficult.
rights?
And that's why it's going to be difficult. That's why you're not seeing applications.
Okay, all right.
And
Do you
maybe
have a-
just again a solution, just thinking from a solution perspective, if the foreign company has less than 50%, it can have still one more 100% cash and carry company, through which again, if depending on the functions performed by cash and carry company, some of the economic activity related benefits will be lying there.
Paresh, tell me one thing, since you've got several structures out there and diagrams, how come if these solutions are available, there is not a single application as yet?
Menka, because these put or have a lot of practical on-ground business issues. For example, this creates a lot of supply chain issues. This kind of structures create are open to uncertainty. How will the government interpret whether it is okay for this kind of structures, not okay for this kind of structures? But I think today the most the biggest issue which is worrying is actually state governments going back on their word. Once you get that kind of thing sorted out, you will see some applications going in. However, with a business plan which possibly requests the government to have a liberal interpretation of the conditions.
Alright, you both have made it amply clear as to why we haven't yet seen a single FDI and multi-brand proposal reach the ministry, and why it might take several more months before that happens. Paresh, Karan, thank you very much for being on the show. Coming up next on The Firm, how SEC is enticing whistleblowers, and SEBI goes for the jugular in the Sahara case, asks for Subrata Roy's detention.